Let us solve some of the questions of capital budgeting. This is question number C 5.1.2. Again an easy question. Except one question, I will categorize all question as easy question. A doctor is considering purchasing a machine at a cost of rupees 120,000. The projected life of the machine is 5 years and has an expected salvage value of 10,000 at the end of 5th year. The annual operating cost of the machine is rupees 2,000. Try to understand, the cost for all 5 years is remaining same. It is expected to generate a revenue of 60,000 for 5 years. So revenue also is the same for 1 to 5 years. At present, the doctor is outsourcing his work related to this machine and earns a commission income of rupees 15,000 per annum net of taxes. Tax rate is 30%. Now this doctor is outsourcing. This point we are going to take, and this is the reason this question appears in classroom. Find out whether it would be profitable for a doctor to purchase the machine. Give your advice based upon NPV method and PI method. Both method will give you same answer. Take present value factor at 9% and so and so. Alright. So what is the cost of the machine? 1,20,000. What decision we need to give to doctor whether you should purchase this machinery or not? Please try to understand what doctor is doing right now. He is outsourcing this. Say if you go to a doctor, he will normally tell you to do scanning, X-ray. Now, normally the doctor will give you a chit and will tell you that go to the scanning place and you get your X-ray done. For that, doctor will be getting commission. Now this doctor is planning to take this machine, to purchase this machine. So his commission income will now stop. Yes, he might be earning some business, but his commission income will stop. We need to advise to doctor whether you should purchase this machinery and stop getting that commission, or you should continue with your commission. All right. The cost is 1,20,000. I can prepare this by doing 1 to 5 years because the cash flows are remaining same for 1 to 5 years. So don't prepare 5 columns, 1, 2, 3, 4, 5. Otherwise, the figures will be repeated. It is expected to generate revenue 60,000 per year. So revenue will be 60,000 per year. Operating cost of machine is 2,000. Operating cost is 2,000. Net revenue is 58,000. Should depreciation be deducted? Yes. To get correct taxation. Depreciation, if nothing is given, I will have to follow straight line method, cost minus scrap value divided by number of years. So depreciation will be cost minus scrap value divided by number of years, which is 1,20,000 minus 10,000 divided by 5. That is 1,10,000 divided by 5. That is 22,000. So depreciation is 22,000 rupees. Profit before tax will be 36,000 rupees. Profit after tax. I never write down tax separately. Profit after tax is a profit before tax into 70%. If 30% is tax rate, profit after tax will be 70%. So 36,000 into 70%, 25,000. If the doctor purchases the machinery, his profit after tax will be 25,200. We are not interested in his profit. We are interested in his cash flow. So we'll have to add a depreciation of 22,000. So it will be 47,200. This is my cash flow. In which year? First, second, third, fourth, fifth, in all 5 years, my cash flow is 47,200. Try to concentrate the most important point in this particular question. Had the doctor not purchased this machinery, he would have earned a commission income of 15,000 per annum for this 5 years. He would have outsourced this work, and so he would have received a commission of rupees 15,000 per annum. If he purchases this machinery, he will not get this 15,000 rupees. If he purchases the machinery, then this 15,000 rupees is opportunity cost for doctor. Alright. He would have earned this 15,000 rupees had he not taken this decision of purchasing the machinery. Now, if he purchases this machinery, he will lose this 15,000 rupees. We have understood opportunity cost in form of interest. I have also told you that opportunity cost of interest is already covered in our present value. But this opportunity cost is not present in our present value. So if we discount the cash flow, only interest opportunity cost is covered. This type of opportunity cost is not covered. What we say about opportunity cost? Opportunity cost, we have written it in our normal all important points of finance. Opportunity cost is relevant for decision making. Are we taking any decision? Yes, we are taking some decision. Then opportunity cost should always be considered. Try to understand what cash flow you are getting. 47,200. What you would have got if you have not taken the decision? 15,000. Then what is your relevant cash flow? Relevant cash flow will be 47,200 minus 15,000. See, I am considering opportunity cost. 32,200 will be my cash flow from 1 to 5 years. Sir, I don't have to pay opportunity cost to anyone. Agreed. But your decision will be incorrect if you don't consider your opportunity cost. Try to understand, we have yet not done time value of money. We have not found out discount rate. Try to concentrate. Had this figure of 47,200 was say 14,000. You can directly tell. By purchasing the machinery, you are earning a cash flow of 14,000 per annum. By not purchasing the machinery, you are earning a cash flow of 15,000. You should never purchase this type of machinery. Is it alright? How we will come to know 14,000 minus 15,000 is negative 1,000. It is negative cash flow, so we will not be taking this decision. But here the answer is not 14,000, it is 47,200. Should 15,000 be considered? The answer is yes. You should always revise this point. A good point of opportunity cost. Now, sir, why I have not deducted it over here? Exactly over here. Because the opportunity cost given is post-tax. Net of taxes, I am receiving 15,000 rupees as a doctor. So, I will have to deduct it from something which is post-tax. If the figure is post-tax, I will have to deduct it from a figure which is post-tax. If the figure is pre-tax, I will have to deduct it from figure which is pre-tax. This figure, say 58,000 minus 22,000 is 36,000. 36,000 is pre-tax. You cannot deduct a post-tax figure from pre-tax figure. 32,200, let us start doing present value. 1 to 5 years, my cash flow is 32,200. Also in 5th year, I will be getting salvage value of 10,000. Any other cash flow? No. So let me find out present value of both this. You can do by GT, right? At the rate of 9%. Actually, you should do it by GT. 1 divided by 1.09. 5 times is equal to GT multiplied by 32,200 is equal to 1 divided by 1.09 is equal to M plus is equal to 2, 3, 4, 5. MRC multiplied by 32,200. It is 1,25,246. 1,25,246. You should get it by GT. Huh? I am not having GT, so I am doing it by M plus. This 10,000 at 9%, 1 divided by 1.09. 1, 2, 3, 4, 5 multiplied by 10,000. 6499, or I can write down 6,500. This is present value at the rate of 9%. This is present value of cash inflow. 1,25,246 plus 6,500 is 131,746. Minus present value of cash outflow is 1,20,000. NPV is 11,746. Positive. Advise the doctor. First, let me also find out PI. PI is 131,746 divided by 1,20,000. 1.098. Again, it is greater than 1. What I'll advise to doctor, accept the project as the project is earning more than 9% rate of return. You should write down the statement. Accept the project as project is earning more than 9% rate of return. In book, the answer might be somewhat different because they might have taken the book factor. Is it all? The factors which are given in the book. If you take book factor, your answer will be approximate. If you directly do it from calculator, if you find out this factor present value in your calculator, your answer will be more near to your approximation, more near to your correct answer. What is the only point important? This one. 15,000, which is opportunity cost. We are going to 5.1.4. All right. Here, you don't think we have forgotten something? Are we selling our machine? Yes, we are selling our machine. At the end of 5th year, if you are selling your machine, there will be capital gain. I agree, capital gain or loss is not a cash flow, but a tax saved or tax payable is a cash flow on capital gain. Sorry, let me find out that capital gain. What was cost of machine? 1,20,000. How much depreciation you have provided in 5 years? Can you help me out? How much depreciation you would have provided in 5 years? 22,000 into 5? It is 1,10,000. What will be WDV after 5 years? 10,000. At what rate it is sold? 10,000. What is profit or loss? 0. If profit is 0, you don't have to consider tax on profit. Please concentrate. If it is SLM method, capital gain on sale of asset is always equal to 0. In SLM method, you don't have to calculate capital gain. It is very logical. SLM method, WDV after 5 years will always be 10,000. How? This is total depreciable amount. As per the formula of SLM, 1,10,000 you will be depreciating in 5 years. So what will be remaining is always a scrap value. And if you sell your machine at scrap value, your profit will always be 0. When there will be profit arising in WDV method, there will be profit or loss on capital. We are going to